Hi, I guess somebody already introduced me already, but once again, my name is Muyao. I'm a reporter at Bloomberg on the crypto team. I heard that if we make any connections about Terra, that will grab everyone's attention. So in case you don't know, when I first joined Bloomberg, the first thing I covered was Terra and Do Kwon. I did an interview with him, and then we did a really long, exclusive story around Terra and Do Kwon. And I will give everyone else here a chance to introduce themselves.
Cool. Hi, I'm Adam Goldberg. I'm one of the founders of Standard Crypto. We're a San Francisco-based venture firm in the crypto space.
Wow, that was really short. My name is Augie. I'm an investor with Sequoia Capital. We are a global multi-stage shop, originally based out of the US, but today operating out of several offices around the world. I'm based in Singapore, and I cover crypto across APAC.
My name is Steve. I'm from BlockTower Capital. We are a US-based crypto firm. I cover investment into public market and private market both. And our private side, I'm leading most of NFT gaming consumer deals.
Hi, my name is Ayesha Kiani. I work at LedgerPrime. We're a multi-strat hedge fund. And aside from that, I also teach blockchain at NYU Tandon.
Great. So the topic of this panel is about investing in the bear, future of Web3 investing. So when I look at the name, I immediately have two questions. The first one is something as a reporter, I'm always curious, I always ask, is that what is Web3? So can each person just sort of tell me in terms of the definition of Web3 in your opinion? Who wants to start first?
Sure. So I think like Web3 is probably an implementation of tokens on a very ordinary levels. I think we're a bit away from that. The other thing is we see more of decentralized infrastructures almost everywhere, like implementations of like, let's say, Arweave, IPFS, the graph. We have started seeing adoptions on that side. So that's what, Web3 would probably mean for, everyday user in years to come.
For me, so Web 1 is read only, and Web 2 is read and write, and the Web 3 is basically read, write, and own. So it's a Web 3 to me is ownership economy, so which is powered by token, which will make that the power back to community users, which Web 2 company couldn't do it. So ownership basically leads to NFT, and then NFT is surrounded by DeFi and DAO, which will make the sort of a metaverse that people are talking about.
Yeah, I think a similar view, the way I like to think about it is Web3 enables digital ownership, so what Steve mentioned, versus Web 2, which was, in my opinion, more of a rental economy in many use cases and instances, right? So these assets imprinted on the blockchain enable true digital property rights, which also have special properties around permissionless, and frankly address many of the specific issues that we see in Web 2 around opacity of the processes and give power back to the users at the end of the day.
Yeah, I think the others covered it quite well, but I guess the short view of my take is that, historically, a lot of technology has been driven by internet networks, and Web3 is just a new form of internet network that has native incentivization, right? An internet network could be something like Twitter, or it could be something like a marketplace, like Uber. And we're going to see these types of applications reimagined with crypto incentives.
Thank you. That was some great answers there. My second question around just this topic is that it's investing in the bear. Usually in a bear market, when economy is not doing well, people want to save money. They don't want to put money out there. So I wonder, in you guys' opinions, why specifically in a bear market it's potentially a good time for investment?
So I think we've started seeing normal valuations at this point, which is the best thing that comes out of a bear market. You see founders being a lot more humble than bull markets because they see that the market is not always rising all the time. After seeing a few cycles in my own lifetime, I can strongly say this, that some of the best projects in our industry has come out of bear markets. So every single time there's a bear market, investors or, prior founders get very interested that what is going to come out of this current market.
Yeah, I agree. I maybe mentioned two things. One is, I think to make a good investment, I think you have to think differently from majority of the crowd of investors. If the majority of people not investing because it's a bear market, you should be the one who should be making an investment to make a good return. So that's more like more traditional financial background that Howard Marks always saying. The second part is related to what she said. I think in my past 4 years investing in crypto space, usually those founders with the strong resilience, which means that even in bear market, they are focusing on their mission, and then their passion to make a difference usually shines because all the sort of cheap money is out, and then all the scammy speculators out. So it's actually best period of time for investors to find the real founders who are building on their mission that without any kind of cheap support that you usually get on bull market. So I won't say making an investment bear market is always best, but I think one of the best period that you should consider making an active investment, which we are doing.
Yeah, I agree with that also. I think, the conventional wisdom is obviously the tourists as well as the tire kickers will hopefully leave the space or spend less time, which results in better outcomes, I think, on both sides for both investors and builders. Tactically, I'm at least hoping, and I'm sure actually many of the investors on the panel would have experienced the decision-making process of last year, which I don't even know if I can call it that, but exploding term sheets, tight deadlines, no real time to actually get to know projects and do proper diligence, which I think is a negative for both investors, but also for builders, right? If you think about this from the lens of you're basically entering a 10-year or more partnership between investor and builder, hopefully you're spending more time to get to know each other and ensure that that's the right fit. And I think the bear market offers an opportunity for you to do that, perhaps slightly better than the bull market.
I think as the others have said, right, if you're an investor with a long time preference, this is absolutely the best kind of market condition to invest into. It may not be quite the same if you're, momentum trading or you're sort of short-term horizon oriented. I guess the other point to bring up is that in this type of market condition, you see a lot of consolidation, right? There's less capital available. Companies may combine forces, whether it's acquisitions or mergers. What that means for DAOs and other types of protocols, I think remains to be seen, but I think we've seen some versions of DAO acquisitions. But yeah, I think these are great points.
Great. So I'm curious in terms Web3, in your kind of perspective, when you're investing a project that's in the Web3 space, what are some of the most urgent problems that Web2 is not yet resolved yet that you need a Web3 trying to, really improve?
I would say ownership, right? Like owning your assets, owning your tokens, owning your identity, owning your own data. That's something that Web3 looks extremely promising for. And yes, obviously, we'll see a lot more implementations in this market and the next one. Yeah, I think that's where we're at.
So why is the ownership that important today versus maybe 5 years ago?
Because, we've seen how our own data and in data hacks and whatnot, is at risk all the time with Web2 projects. Like whatever I'm putting out on Facebook or whatever I used to or Instagram can be shared with anyone at any given time without my consent. And I think that my generation probably was slight okay with it, but the younger ones are not. They want to own their data. They want to have value over it. So I think that's going to be a bigger topic. Identity, I'm not saying that, be an anonymous founder, but owning your identity, that identity on a wallet, that also holds a lot of significant value as compared to what we see in traditional banking. And then owning your assets, the option of just you moving a couple of $1,000s without intermediary parties, it's a lot more promising than, you know, just me sitting here and just talking about it.
I'll just add just one thing. I think I agree most of the point, and I would just add one thing. I think the world is becoming more decentralized, and then as you guys notice, we can work from home from anywhere, which means that even though we recover the COVID, I still think that this style will remains at the big portion, which means that going forward, I think more and more important to have a personal brand, which will become sort of a company you work for. So now is working for Goldman, working for McKinsey, but I think in the future, Steve Lee, what the brand, what the thing that I have, I think personal brand become more matters, which means that until now, we contribute a lot to the Web2 company, we get nothing. But as we go into the world that personal brand become more important, we should get rewarded on based upon our contribution to whatever the thing. The token and ownership, the blockchain, everything is definitely that makes this possible.
Yeah, maybe I can take a sort of Southeast Asia focus on this question, just given that is the region that I know best. For those of you less familiar, I mean, there's a lot of retail and user demand. If you look at, you know, MetaMask top markets, 4 out of those top 10 countries reside in Southeast Asia. And I think in these markets, there's some pretty obvious use cases that come up, right? I think, for example, offering decentralized financial services, maybe it's hard to see the incremental value prop when you already have 5 bank accounts and 3 credit cards. But for 70% of Filipinos that have no access to financial services whatsoever, it's fairly clear, right? Or another example could be, you know, maybe for certain segments, it doesn't make sense for them to work metaversal jobs, playing games, earning, you know, $30 a day. But for retail workers in Ho Chi Minh or Bangkok, that's, you know, 3 to 4 times their daily living wage. And so I think those use cases make a lot of sense in the emerging markets where we refocus our time.
Yeah, I mean, I guess your original question, right, was sort of about what use cases does Web3 enable that Web2 didn't? And I'd actually push back on the frame of the question in the sense of, if you think about a lot of things in Web2 or Web1, right, go back to Uber for a second. Uber didn't invent the concept of transportation, right? It just brought aggregation of supply and aggregation of demand, which brought certain benefits to the business model. With crypto, you know, if you think about networks, right, to go back to my earlier point, or think about marketplaces, it's really about a new pattern for trust, right? You can establish trust more directly between supply and demand, right? Whether that's an Uber-like app, or I think you, Steve, talked a little bit about kind of decentralization of social networks earlier. And this lets you give everyone a better economic deal. And you also can allow users to participate in the governance and provenance of the system. And I think that's what's really new and exciting here. I think that's why we're going to see new versions of crypto-enabled social networks, new versions of, you know, traditional mass market use cases like Uber and Lyft and Airbnb and so on. That's what's really exciting today.
Those are all really good points. Basically, that Web3 can still be about creating a Twitter-similar product and Google-similar products, but it's going to be in a much more decentralized and more community-based, and kind of like getting involved, having more people participating and involved in a much more equalized way. I guess that my next question is about sort of, you know, like, since we're talking about investing in bear, that it's hard to ignore that right now we're in a bear market, sadly. And it's been 6 months, 7 months or so. I'm just wondering, what are some of the biggest lessons you've learned as an investor in the space in the past few months that you're gonna take, you know, kind of going forward and really remember that and, you know, and taking that lesson from?
I think that, so lessons learned. Fluff doesn't sell if you don't have a real, some semi-real product. It's very hard to get by, especially markets like these will literally bust you out hard. The other thing is code always matters. So I know our industry is very heavily focused on, you know, build fast, break things faster, but we've kind of started realizing that it's not a very scalable idea. given all the recent hacks we're seeing on L1s and, bridges and whatnot. And the third thing is, I don't know, this is something that, Steve and I were talking about in the room, was how much room do we have for more L1s? Like, is the market going to absorb the current ones, or the best ones will thrive, or how much will go for, adoption? So, yeah, I think that's what I'm interested in.
I think it's very cliche thing, but I think what I always keep learning through this cycle. So I've been in this space since 2017. So it's been, I think, third cycle, a bull and the bear cycle I'm going through. One thing that I learned, and I still have a very strong conviction with, is the real founders and good founders are shine during the bear market. So that's something that I mentioned earlier. On the public side, though, it's all about when people become greedy, you have to be more skeptical. When people are too fearful, you have to be optimistic, positive mindset. So I think those are the things that I just keep being reconfirmed every time I go through a cycle. There's nothing new. It's more a matter of how much you can implement what you know into your actions.
Yeah, I think without getting into specifics, the two learnings that come to mind for me, one is brand is not a substitute for real risk management. I think we've seen that over and over again over the last 6 months across ecosystems, CFI, funds, etc. And I think many people in the ecosystem made decisions based on sort of the reputation within crypto native circles of certain institutions and names, and that will hopefully change moving forward. I think the second thing is what we discussed earlier, which is the music has definitely stopped, or at least appears to be so, at least for the short run, and that is an opportunity in itself for us to be more judicious when it comes to entry price, but also do the first principles work that we should be doing always, which is thinking critically about, is this a long-term oriented team in a very large market that will build an enduring business over the long run?
Yeah, I think to add on to Augie's point, right, risk management was really sort of the lesson of this cycle. I think there's good risk and there's bad risk. Good risk is using funding to power research and development and new innovative technology. Bad risk is pretending that you're a fund when you're a company, or pretending that you're a fund when you're a project. And I think that, look, the space has come so far, but still is really early. And I think we're going to look back on this point in time and be really impressed by all the things that already existed and all the things that are yet to come.
Yeah, I think you brought up a really important topic, I think, in the sort of Web3 investment is risk management. As a reporter, I would say I receive so many pitch like every single day about all kinds of wild like crypto projects. And one thing people often like, the first thing they pitch to us is usually who and whom, those big names in the space are pitching, are like backing us. That's why you should cover us. We are the next big thing. I just curious, as some of the biggest investors in the space, how are you guys considering in terms of the risk management in the space right now from the VC side?
I mean, so we're a hedge fund first, right? So we weren't very fond of like leverage to begin with, and then early in the year, given the market, we kind of like just deleveraged altogether. From the venture side, lower valuations or medium-sized valuations, because if you're going to put in a large check at a high valuation, your chances of the return is pretty slim. And then the other thing, as far as risk management goes, we've seen projects that ended up using their treasury and parking it just for the sake of yields with, some they were reputable, but like basically hedge funds that didn't even have audited financials. So that's something a lot to say about the founder, that if you're going to use all the capital that you've raised, use it as your treasury and then just hand it over to someone else. I think there's going to be a lot more questions around on how each and every project is managing its treasury going forward and in months to come. So that's something that we've started to ask over and over again, that what are you going to do aside from building? Yes, we get it. What are you using your treasury for?
So your question is how we implement risk management in our investment?
Yeah, I
Okay.
think in general in the crypto space,
Gotcha.
what are you seeing? Yeah.
Gotcha. I think it's all about balance. So speaking of the big picture, I said two things. You have to buy good products with the good buy. So good product means more long-term oriented. You want to buy quality product, but at the same time, you have to buy good price. Even though the product is amazing, if you pay like 1 million, it's not a good investment. So it's two things, but the good product is more geared toward the venture investment, because venture investment to me is all about people investment, long-term investment. It's more growth potential investment. But when you go to the public market investment, it's a good buy, which means that how much price that you pay is extremely important. So me at the current firm, I spend 50% time on public market, 50% on private market. So I balance these two, depends on the market I'm going after. And then the second point I want to make is the risk that I'm looking at is about 5 risks. So one is a market risk, second is the execution risk, and third is a deals risk, and the fourth is counterparty risk, and the fifth is, I think, credit risk. So when I said deal risk, which is not common, the term that people use is, in crypto space, the deal structure is very important and they're very ignored by many investors. Many people care about who are in the cap table and then what's the valuation, that's it. And actually, if you read through the legal doc, which I'm not expert on, but there's basic things that you have to catch on, that deal structure is not really favorable to investors. You have to at least be able to yellow flag it. So those are kind of 5 risks that I'm looking at for general public and private market investment.
Yeah, I don't really have much to add. Maybe one small point is we always ensure that our companies have robust financial reporting practices. I think in crypto, the complication there is obviously there's on-chain data, there's off-chain data. I mean, it's almost funny saying that because theoretically everything being on-chain should make this an easier process, but it's not, right? The traditional auditors and financial services companies are not well-versed typically in this new world, which is perhaps an opportunity for someone out there.
Yeah, I think the only other point to add is from more of a venture manager perspective, it's time diversification. I think in crypto you see all-time highs and all-time lows, sometimes in really rapid succession. And it's really important to not build a portfolio that's too overexposed to one point in time. So taking a breath and having time diversification is a really important mechanism as well.
I think one thing to add is a regulatory risk, basically.
Do you want to kind of specify what do you mean by that?
No, I think each country and each sector has different regulatory risk, DeFi or stablecoin versus NFT, and Japan versus Korea versus China. So I think risk is very varying factors for investors to be comfortable with the particular investment. Every investor has a different risk appetite, so yeah.
I think that's a really good point. I guess that my next question is just going to be about that. Since we're right now in Seoul, I'm just wondering, from all your perspective, we have some US-based firm here. We also have, some Southeast Asia-based firms here as well. Just wondering, what are you seeing sort of the difference between projects, mostly US focused versus here more Asia focused? Is there any major differences? And even like maybe some preference, which are the firms you're mostly interested in?
I'll start. So basically, my biggest role at the firm is to be bridge between US and Asia. So I spend 1/3 of my life in US and 2/3 in Asia, breaking down to Japan, Singapore, and Korea about equally. So one thing I'll mention about difference is a lot of people in the US, let me start this. I think I'll put the very simple word. US is more fundamental, technical driven, and Asia more the adoption and then the execution and then let's get the product out. I think both sides is very important, but it's not good that it's doing one side deeply. If you keep talking about fundamental philosophy, debate on Twitter, and without product, what's the point? But it's to keep producing out the low quality without thinking about fundamental, what's the risk behind it, that's also not great long-term product. So I think I always see these two different angles, so try to see the balance for the investment I'm making. Second is a lot of U.S. investors think that Asia is all same, but Japan, China, South Korea, Singapore, all different. Speaking of the country that I'm familiar with, Japan is more driven by financial institution like a Nomura, SMBC. In South Korea, it's driven by more conglomerate like a SK, Samsung, or Hanwha, or something like that. And then China is basically driven by state government or sort of government-related agencies. So even though if you don't understand the mechanics of the country's specific business kind of practice, I don't think you can make a great investment. Because in crypto, from day one, you have to be global. But to be successful with the business, you have to be local for your execution perspective. So always it's important to think like a global, act like a local, but you have to think like a local, sometimes act like a global.
I think in Asia you find retail adoption more easy than US, because in US we're just always stuck on regulatory aspect. And even though we've been trying to, like the US projects have been trying to find loops around, SEC requirements or CFTC requirements, on the other side of the world, these chains and these protocols or DeFi projects, have like millions in TVL already. So that's the difference.
Yeah, not much to add here. I think I agree with Steve's point. It's a difficult topic to discuss without kind of delving into more generalities, right? But I agree with the point, and we are a global fund, right? So I have colleagues in the US that cover those markets, Europe that cover those markets. And I think broadly, yes, in Asia, we tend to find a lot more application level development, just playing on the strengths of developers in this region. That could take the form factor of a bunch of different things, consumer internet type apps, GameFi, obviously, which is pretty massive, not only in this market, but also places like Vietnam with a strong mobile development talent. I mean, it's not a super well-known fact, but Axie Infinity, the majority of their team is actually based in Vietnam. StepIn, which is one of our seed portfolio companies, not exactly GameFi, but I would say mainstream consumer app, is a Chinese team based in Australia. So I anticipate, and frankly, we're looking for more of these types of opportunities in this geography.
Want to add anything? Great. Great. I think like my next question is going to be about sort of relationship between investors and founders. Like Web2, we have WeWork, Uber, and all these firms have very interesting founders, and there's books and documentary or movies about them. Web3 crypto is also a space full of very interesting people. Just wondering for you guys, like, how are you seeing the kind of relationship between you as an investor and the founders in Web3, and are there any challenges and how you are kind of like resolving this?
So we're a liquid fund first, which means that almost everything that we invest in has to be in a token form or DeFi form where we could see our returns. We barely do venture style. So what that means is that any project that we're investing in, which is DeFi focused, will be market making on it, or we were providing liquidity, or we'll be establishing their yield pools. So we're very much hands-on in almost everything that we've invested in, let it be Sage, Ribbon, or Hashflow. So that's what we do.
Relationship with founders. So I'll break it down to 3 ways. So one is when founders are raising, so when they're talking to us. I think relationship is, the preferred relationship is usually founders are so excited, so passionate about their principle and what they're building. So oftentimes that's great, but what your goal is to get the money from me. So which means that you have to tailor your story or marketing strategy or fundraising strategy that's sort of satisfy what we want to know. If the founder keep pushing on their communication style or their style, which doesn't align with us, then even the product is amazing, it's very hard for me to be convicted. So that's the one. So, and then after we make an investment, let's say the investment become a token listed on the exchange, the relationship is also become different, which means that we as investors, we want to know about how you guys are doing after you raise. So in traditional world, there is called investor relations, but in crypto, it doesn't exist. Even founders think that once they finish raising, that's done with the investors, but it's wrong. Not just investors need to add value to the portfolio company, but portfolio company also need to update us that you guys are doing great. Or sometimes if your performance is not good, it will give me valid reasons so that we don't sell your token. So I think relationship is more, it should be both way in that way. And then lastly, the way that we add value to the portfolio company, I think portfolio company founders often dump a lot of information to investors, like a lot, so that we don't know how we can help. So there is a very limited, every fund managers has a different strength in terms of how they can add a value portfolio company. So you founders and investors should communicate very actively and then efficiently so that they communicate well what they need and then whether we can provide that things or not. So long story short, I think it's very active, consistent communication is required to be very good relationship to make both sides happy.
Yeah, I mean, I guess the short of it is that founders in crypto are really sophisticated. They expect their investors to be service providers. And that could be more on the company building side, right? If it's a company structure, it could be board membership, it could be helping with exec hiring, it could be thinking about, regulation and compliance, go-to-market, network effects. But there's also a new crypto native side of it, right? It could be running nodes on a network. It could be helping think through smart contract audit strategy, helping design token economics, being active in on-chain governance. I think the biggest difference in this world is that crypto's just a lot more 24/7, right? If you look at DeFi, it's the first time we've ever really seen finance operate at the speed of software. I think, you look at the old world, people weren't used to getting telegrams at 2 in the morning every day. And I think that that's what's really neat and exciting about the space, is it just moves faster.
Great. We don't have much time left, but before we end this wonderful session, I want to give everyone a little bit of time in terms of like the shilling side. In the Web3 world, in this bear market, what are some of the most investment you did that you are very proud of, especially in today's bear market environment?
We're registered with the SEC. I'll pass the question along.
So are we, but I feel like DeFi projects, because saying that we talked about lenders early on. DeFi survived, CeFi didn't. So DeFi, and I would say a couple of infrastructure projects. Those guys are going to turn out to be the backbones of the industry.
We are also SEC registered, so I can talk about performance. But because in terms of just public information, in Korea, we invested in PlayDAP back in 2018 as only U.S. investors. They are the now only Korean crypto project listed on Coinbase, which is fantastic performance for them. And also we invested in League of Kingdoms last year, along with the Sequoia and then Binance and A16Z as a only U.S. crypto native fund. They are the first real strategy blockchain game. I'm proud of them because one of the big thesis I have for the NFT gaming investment is basically Web2 quality game to the Web3. So I think the League of Kingdom guys are basically Web2 traditional mobile or game developer veterans and whose understanding crypto is phenomenal. And then they have been working for this project for 3 years. They didn't initially issue the token. When other people issue the token to raise easy money, they decide not to because they think there's a scam. So they build the users community first for 2 years, and then they issue the token when their game mechanic really makes sense with the token. So I'm very proud of those two companies here in South Korea.
Yeah, I won't get into specifics, but maybe thematically, a couple areas that we're excited about. Mainstream consumer use cases, as I already mentioned, that hopefully onboard new segments into crypto. And then at the infrastructure layer, I think while debatably scalability is an issue that we're in the process of solving, there are still issues around identity, privacy, and of course UI UX that we're backing strong teams in as well.
Yeah, I guess to look at it from a different perspective, when you think about stage for an opportunity in this type of market, it's really interesting to do things that are at the inception stage, that are brand new ideas, that are innovative, or things that are a little bit further along that maybe are being mispriced by the market but are still working and are going to make it to subsequent cycles. Great.
That's a very wonderful panel. Even though I have no kind of experience in investing at all. I learned a lot from all of you. Thank you very much for your time.